This is the Insight is Capital podcast.
The views and opinions expressed in this podcast are those of the individual podcasters and do not necessarily reflect the official policy or position of advisoranalyst.com. This podcast is meant to be for informational purposes only. Nothing discussed in this podcast is intended to be considered as advice.
Hello and welcome to the Insight is Capital podcast. My name is Pierre Daly, managing editor of advisoranalyst.com. Our guest is Michael Greenberg, Vice President and Portfolio Manager for Franklin Templeton Multi-Asset Solutions. Michael is a member of the Franklin Templeton Multi-Asset Solutions Investment Strategy and Research Committee, specializing in fixed income strategy, and has co-portfolio management responsibilities for all Canada-based managed programs, including Franklin Quotential and Franklin LifeSmart. He also manages institutional mandates in North America and Asia. Michael Greenberg joined Franklin Templeton Investments in 2006. Without further ado, our conversation with Michael Greenberg. Michael, welcome to the show.
Hi, Pierre, and hi everyone who's joining us today. Thanks for having me on the show.
Great to have you. Michael, the last 9 weeks have been, to say the least, tumultuous. The COVID-19 pandemic, economic shutdown and shock, fastest bear market on record, seizure and dislocation in bond and credit markets, followed by massive Fed and government intervention, also Bank of Canada intervention, and at least for the time being, what appears to be a V-shaped bounce off the March low. What are some of the big conversations you're having with advisors and investors?
Yeah, I think you summed it up pretty well. You know, one thing we're just trying to remind people is we do need to separate the stock market from the economy. So clearly, it was unprecedented how quickly the market collapsed, really record-setting. But as well, the recovery or the bounce back from the bottom has also been somewhat unprecedented. So that, in that sense, the V-shape down and up is a great analogy. I'd say from an economic standpoint, though, we've only seen kind of that first part of the V, the down part. We haven't really seen the economic V-shape recovery, and we don't expect that. So that's one thing we're just reminding investors and advisors and their clients is that, look, the market is going to be volatile. It's probably not signaling the all clear. So do expect a little bit more volatility and do look at, asset allocation, look at allocations and things like that to see if there is some opportunities to maybe, rebalance into some weakness. Because, as we do look out a little bit longer term, we're a little bit more positive on the ability of stocks to outperform bonds and cash. But That being said, because of that more, I guess I would call it more of a U-shaped recovery on the economic front, we would expect a little bit more volatility, going forward. I'd say the other thing we're kind of talking about and are getting asked a lot is when we look a little bit longer term, what are expectations or what kind of expectations do we have as far as the return potential of, the traditional 60-40, balanced portfolio? And I think, there it's quite interesting times because obviously a big component of a lot of those portfolios is government bonds. Developed market government bonds, whether it be Canadian government bonds or even U.S. Treasury bonds. And clearly with the really unprecedented decline in yields that we've seen in those markets, that's really taking away from forward returns. So that part of the portfolio is going to be challenged going forward. That being said, we've had a bit of a reset on credit. We've had a bit of a reset on equities, and that probably increases the expected returns going forward. So I would say, what we're saying to advisors at least is, you might want to take down the return expectations of that sort of 60-40 portfolio compared to what we've been able to experience in the past 10 years, just given it's been such a good environment for stocks and bonds. But definitely not all is lost. It's still going to be a good place to be for kind of that more moderate investor. So that's just some of the things we're talking about outside of the typical questions on the CAD, energy prices, and of course what Donald Trump might tweet next.
What kind of stories are you hearing back from advisors?
Yeah, it's funny. We're obviously not going to see advisors face to face anymore. But when we used to, when you look on the typical advisor's wall, there's a CFP. Maybe some might have a CFA or some of the programs from the CSE, the diplomas on the wall and whatnot. And we always joke that there should be a psychology degree up there as well, because the investors, a big part of dealing with kind of face to face clients is, of course, the sort of behavioral finance, sort of psychology part of investing. And that's a big challenge. And a lot of advisors we talk to are facing that in the sense that typically when things go really badly and there's volatility in markets and headlines that are horrible in the newspapers and whatnot. That's typically after we've already seen a pretty big decline in markets, to be honest. But that's the time when a lot of people become very risk adverse and want to, not only kind of stay firm in the market, but actually take money out of the market and go to cash or go to more conservative investments. And a lot of times it's the wrong time to do that. So one of the things that we're really talking about to advisors is how to kind of deal with the behavioral finance part of investing, the kind of emotional part of investing. And I don't mean that at all in a disrespectful way to investors, because even professional investors, even institutional investors suffer from some of those behavioral finances. And I think what's important for groups like us is to create an investment process that tries to help us be a little bit more analytical and a little bit more emotional when it comes to investing. And I'd say secondly is then, what to actually propose to a client as far as what to do at this point in this juncture. And on that front, what we're typically saying is, look, typically, a good financial advisor will have a financial plan for their clients. So it's stick to that plan. If they're a little bit underinvested, I would take some opportunities here if you see some weakness to potentially add a little bit to markets, to not get too conservative within portfolios. I don't think I'd be overly aggressive at this point either, just because we think there will be some fits and starts here from a stock market perspective, but to take some opportunities to sort of, buy the dips. I'd say 6 to 8 months ago, we were suggesting to sell the rallies. We were a little bit more conservative in our asset allocation, a little bit more conservative on our outlook. And that was probably the time to maybe take a little bit off the table. Right. Now that we've seen kind of a drawdown, and to be honest, we've seen a 50% retracement of that drawdown, so that we're not picking the lows at this point by any means, but you're still at a lower point than you were a number of months ago. So cautiously adding a little bit back to risk on dips, we think is a decent strategy. But again, sticking to the plan. A lot of the financial planners that we deal with, their clients are not looking at markets on a month-to-month basis. It's really more of a multi-year approach where they're looking to either preserve capital or build that nest egg, whether it be for retirement or for education or for whatever.
Yeah, I think this idea that market timing somehow is possible, there's much greater chance that you're either going to be too early or too late. And then for advisors and for portfolio managers like yourself, that involves career risk as well, right? Often the problem is that the decisions are discussed almost in a black and white way. Like market timing is am I in equities or out of equities? And I think that's where things really have taken a long time to evolve in terms of discussion, and even the idea of staying the course with a structured portfolio or an optimal portfolio, and then making fine-tuning moves when the time is sort of determines that it's right. Like we've had a market that's been rising. We had a market that was rising with a few interruptions for 11 years, right? I mean,
yep, absolutely.
And it probably took a lot of investors a long time to get back in within those 11 years following, 2009.
Yeah, and I'd say not even kind of, mom and pop retail investors, but we saw that even at the professional level, even at the mutual fund level, where certain managers or certain management teams made a great call to go to cash or to get really defensive, kind of as we had the crisis, and obviously did fairly well in the downtime. And that's one good decision. But then there's a very difficult second decision that has to be made about when to get back in. So you need to be right twice, and you need to have fairly decent timing. And what happened in a lot of those cases is they were right on the way down, which helped their relative returns and absolute returns, but then stayed way defensive, way too long,
right.
and then really gave up a lot of those relative and absolute returns on the other side. And there's a saying in investing is a lot of times, you can be right, but you may go broke before you're right, before you're proven right. And one good example is many hedge funds for many years were pretty aggressively shorting Japanese government bonds in the view that the amount of debt that was being issued by the government would eventually force yields to go way up to attract investors into that government bond paper. And of course, higher yields means lower prices. And we saw actually completely the opposite. The theory was sound, but the timing was way off, and we still haven't seen that actually play out. So, many of those hedge funds went broke before they were proven right. Same example in the tech wreck, there was many, more value-oriented investors or whatnot that really, arguably way too early avoided technology or even more aggressively shorted technology. Now, eventually they would have been right, but their timing was off and they probably went out of business well before they were able to prove themselves right. So, there's not one perfect way to invest. I mean, there's different investment styles out there. We have our own. Most of our advisors that we work with and most of their clients do tend to be more medium to long-term investors. They tend to be more like pension style investors. So, the way we kind of tackle it is you want to start with a really good strategic long-term asset allocation mix, something that is going to have a good probability of meeting whatever outcome you're looking for, whether that be a capital preservation outcome, an income outcome, a growth outcome, or some sort of mix of those three.
Right.
But then around the edges, we believe that it does make sense to be a little bit dynamic with that asset allocation. So not market timing, but I would say more shifts. So, when valuations are getting a little bit more extreme, maybe when the CAD's getting a little bit more cheap, when credit spreads are really wide, you might want to lean against that a little bit and sort of take the other side a little bit, just as, there's potential higher returns in doing that. So, I think there's nothing wrong with being a little bit dynamic with the asset allocation, shifting around allocations within reason. But the whole, market timing as far as, going 100% to cash one day, 100% into equities the next, for us, it just doesn't really work. And that's sort of how, kind of how we're looking at it. I think that's, probably a good way for most people to kind of position themselves and position their kind of, philosophy around how they want to build portfolios for the bulk of their clientele.
In most advisor-client relationships, the trust component where the client says, whatever you think is best, and then the emotional aspect comes in, and I think it's the emotional aspect for the average investor that makes the work even more challenging for advisors and money managers, which is that, I don't care, just get me out. I don't like what's happening. I'm scared. My retirement is in 3 years, and that sort of thing is very hard to overcome. I mean, that's the advisor's job, right? Is to make sure that their client doesn't make that supreme mistake of possibly getting out at the right time, but then never getting back in subsequently. And every decision increases the odds of failure. And so, yeah,
a lot of that is it probably comes down a lot to trust. So if there's that trust between the advisor and the client, they're probably more open to hearing advice that maybe doesn't feel right. But at the same time, we have to take emotions into it. Like if there's an investor who clearly can handle more risk, they have a long time horizon, there's no cash needs, et cetera, but is for lack of a better word, a worrywart, it maybe doesn't make sense to put them through the stress and gyrations of markets going up and down.
Problem arises around possibly clients whose risk tolerance was not determined properly in the beginning. And then something like COVID-19 or any sort of exogenous event happens and the market tanks, and then they panic and they say simply, the conversation is, I don't care, just get me out. And that's where advisors earn their keep, is as to whether or not they're able to prevent their client from making those behavioral mistakes. How do you overcome that situation where a client panics and no matter what you say to them, that's that? I mean, they may be right in panicking, given that, we've experienced markets like 2009, but the long-term outcome of that is where things go terribly wrong.
The worst thing you can have is an unhappy client that doesn't tell you they're unhappy, right? It's sort of that worst case scenario where you have someone who's unhappy with your service or the outcomes or whatever, and then rather than saying anything, they just leave. You just get that form that's telling you that they're transferring their money out. So it's actually a good opportunity. It's actually a blessing in a way when the client comes to you with something like that, because it allows you at least the chance to try to steer the ship back on course. So, taking that as an opportunity to review the financial plan, to sort of remind the client of what they are trying to achieve within their portfolio as part of a larger financial plan that, of course, involves tax planning and insurance planning and estate planning and all that kind of stuff. And taking that time just to review that plan. And then, then suggesting a way to kind of right the ship. Now, at the end of the day, you can't force someone to do something they don't want to do. And it may be a learning lesson for them where they just absolutely do not feel comfortable going into the markets, I guess, against the advisor's advice. At some point, I guess you have to accept that. and then revisit, 1, 2, 3 years later to see how that turned out for them, and then take that opportunity to sort of retest again. And in a way, I know in some of the anecdotal evidence that sort of we heard is those advisors in 08, 09 that, suggested clients stay the course or even add more money. Those clients that didn't, of course, regretted it, but that actually solidified the bond a little bit between the advisor and that client, and that trust actually grew. So, in a way, I guess there's sort of two courses of action. One is, of course, is you respect the client's wishes, and you maybe keep them out of the market against what you think is best, and just make sure that that's documented and clear. I think that's the opportunity is you've got someone who's quote unquote maybe unhappy that's actually coming to you rather than not coming to you, not telling you about it. So it's just taking that opportunity to kind of sit down, revisit the plan. Again, we've got some materials at our firm that we use with advisors just to show clients just some of the risks and potential negative outcomes of allowing some of those emotional behavioral biases to slip into your decision making, and show those consequences on more of a numerical standpoint of, here's the opportunity cost of missing out on, X number of the best days of the year, et cetera, stuff like that. So, there's ways to kind of build a quote unquote presentation or client facing messaging deck around that to sort of help people with those types of conversations.
Yeah, ideally, that would have been a conversation that would have been happening during those great 11 years. Yeah,
absolutely right. Yeah, I mean, that's the ideal. And we definitely know there's more experienced advisors and less experienced ones. So those that have been around a while, they've definitely set some expectations with clients and vice versa, and have been able to kind of achieve those and respect them. End of the day, no one can really control what the markets can do.
Absolutely.
But we can control, expectations. Again, the advisors that we see that are the most successful, it's reminding them that, the piece that I work with day to day, which is the actual portfolio and the rate of return, that's of course an important component. But it's only one component of what that overall nest egg will look like for that client at the end of their time horizon, whether it be at the end of the savings for education or an RRSP or whatever the account is. I don't want to downplay the importance of building a good portfolio and getting a reasonable rate of return, but there's a lot of other things too that have to happen.
Absolutely.
As well.
So given the downturn, the equity portion would have dropped to about 39%, right? So 60% allocation in equities would have become about a 39%. After a 35% drawdown. The bond portfolio, assuming there was some moderate duration, would have increased in value as well, given the fall in yields that occurred subsequently. So there would have been some mild offset from the bond sleeve of the portfolio and a substantial drawdown on the equity sleeve in the traditional 60-40 portfolio. And the ideal situation there, if you can get your clients on board, the ideal situation there is to actually rebalance into equities.
That's right. Yeah. And I guess a couple things there. I mean, one, when you look at kind of the peak of the high to low in the S&P 500 or the stock market, whatever, to your point, down high 30s%, the 60-40 was not unscathed in that environment. Many 60-40s, kind of the average 60-40 was down, high teens. Which is a pretty big negative number for a 60-40 portfolio. So absolutely, the bond part of the portfolio was there to absorb some shock, but it was still a down market. Now, coming out of that same portfolio was up almost 10%, I think almost 15%, from the bottom, those sort of 60-40 portfolios. So again, it fell, but it rebounded. So on an absolute return perspective, especially just given the timing, that first quarter statement for many people was a little bit surprising, to say the least, I'm sure. Now, they probably haven't looked at April yet, and of course we've retraced some of that, so it's a little bit better. But yeah, that's something that we do, within our portfolios. I know advisors do that as well, is making sure you're kind of thoughtful about rebalancing. And that was, to your point, that was a great example. So, as March was kind of rolling along and we were seeing some pretty devastating returns in markets, it was definitely something that we were doing, was not only kind of rebalancing back to where we were before in portfolios, but actually even adding a little bit. We were a little bit underweight risk in the portfolios going into it. I can kind of talk about that later if you like, about why, but we were a little bit underweight risk in the portfolios. But after that kind of reset, for us, it was an opportunity to actually add a little bit. So we kind of were adding to risk. But absolutely, I think that was an opportunity, again, very, very emotionally difficult to do, to be buying back equities, which were down 30% and selling some of your fixed income that did fairly well. But that's the discipline, I think, that's needed in investing. The other thing I'd say too, and again, we can also hit on this a little bit more if you like after, I'd agree with you that the fixed income side was there to hold you in, but it really depended on what kind of fixed income you held. If you were kind of over your skis within the fixed income part of your portfolio with a lot of credit risk, a lot of high yield bonds, you were smashed pretty good, because a lot of those markets sold off quite a bit. Again, I can talk about what we were doing. We were a little bit more conservative. So, the government bond, the developed market government bond part of the portfolio definitely did very, very well as yields, are at very, very low levels now at this point. So that was a positive return. But I just didn't want a blanket statement that fixed income did really well, because there was definitely a lot of dispersion within fixed income over that period. And again, I think that actually does create some good opportunities going forward, we think. But I think it's an important distinction to make as well.
Given that investors there's been really a dearth of, in terms of traditional developed government fixed income, there's been really a dearth of yield there. I mean, it's been really hard to get any kind of meaningful income from those assets. And even now, with the drop in yield, there's been a gain in valuation, which is where the offset comes from. But now that that's happened, and now that yields, if you had governments in your portfolio as a core fixed income holding, around now would probably be a decent time to look at rebalancing into some of the more opportune areas like credit, like high yield, like investment grade.
Yep, I agree. I mean, and that's that. When we look at the rebalances that we were doing in our portfolios, we talked a little bit about what we were going into, and that was a little bit of equity and even a little bit of credit. But the source of those funds was developed market government bonds. Now, to be clear, we would not abandon those completely in portfolios. We still think that the developed market government bonds, although yields being at fairly historic lows, suggesting fairly muted returns going forward, to us still do play a role as far as that diversification, capital preservation component within the portfolio, especially given that even though, a 60-40 portfolio is fairly diversified, when you look at where your risk is coming from, a vast amount of your risk is equity risk. We know that the equity part of that portfolio dominates the risk component of the portfolio. So, going forward, we still think government bonds will be there for you as far as diversifying that equity risk, but it's not going to be like the last 25, 30 years where not only did we get an asset class that is a good correlation benefit in a portfolio to the equity risk that you're taking, but you were also getting a really nice return out of it. It was sort of the best of both worlds. You're basically being paid to take on an insurance policy. And that's, we know for those that deal with insurance, that's generally not how it works. So that's been a great environment. I don't think it's dead. I don't think that's over, but I think we have to reset a little bit the return expectation side and the amount of diversification benefit that we're going to get. We think it's still there, but it's a little bit weaker. So from a Canadian's perspective, we have to look at what are some other things that we can hold in portfolios that help diversify equity risk that don't cost very much or potentially even give us a small positive return. And that's really a big part of some of the more strategic research that we're doing at the firm. The PhDs and propeller heads at the head office are really looking at some of the different asset classes that are out there. In Canada, currency is a great way to kind of offer a bit of diversification. Inflation protected bonds, gold. There's other asset classes that we can look to complement that government bond exposure. And, going back to your yield question, in a way, this is all by design, right? The whole financial repression narrative is very much, for the central banks to get yields very, very low, which forces investors to get out of the safe stuff, the government bonds or cash or whatever, and to go up the risk spectrum a little bit, whether it be investment grade credit or high yield bonds or emerging market debt or dividend paying equities. And that whole, portfolio rebalance effect, in essence, is meant to help kind of stimulate a bit of an economic recovery. We'll see how that works out. But, so that's sort of by design. So, from a yield perspective, to be honest, we definitely have some portfolios that are more focused on yield and generating a certain income, in which case, we look at different parts of the fixed income market. We look at different parts of the equity market. There's ways in the options market to create synthetic income as well without taking too much risk. There's emerging market debt selectively as well. So there's ways to kind of be a little bit proactive and dynamic about trying to keep the yield up in those portfolios. But in many of our portfolios where it's really more the total return that we're most concerned about, we're a little bit agnostic on whether that return comes from income or whether that comes from, capital gains. And obviously, generally, it's a combination of both. But, that's definitely going to be a challenge for those that are relying on income to fund, day-to-day living, because you can't just go buy, you can't just go and ladder, 10-year government bonds and expect to get, 2-3%. In fact, you're getting, 0.5% now. And then after taxes and inflation, it's probably actually a negative yield. So yeah, I think for kind of an income investor, again, we can go into more detail, but for an income investor, I think there's ways to still try to generate a decent income, but it's going to require being a little bit more dynamic. And I think to one of your points earlier, when you look at kind of that payment or that income you're getting on a government bond, you've gotten a good capital appreciation from those government bonds because the yields have gone down, the price has gone up. To rebalance into stuff like investment grade corporate bonds, we wouldn't be too aggressive just yet, but maybe at some point going into things like high yield bonds or bank loans or things like that, which now are yielding 7%, 8%. You can get some pretty good yields off some of that stuff. Of course, you're getting return on your money, but the return of your money is more risky. So you have to be careful. But, I think there's some opportunities still to be a little bit more dynamic and proactive in a portfolio to still generate, a decent income for people. But it is going to require a little bit more, a bit more activity, being a bit more active.
I want to say that the decision-making landscape is far more complex than it appears. I'm listening to our conversation, and what is the trend? You're part of the multi-asset solutions team at Franklin Templeton. What do you see is the trend in terms of advisors / investors going from individual solutions into managed solutions? For example, you guys run Potential. You have LifeSmart, which you're part of running. Do you see advisors and investors wanting more of that?
Yeah, I guess in a way I'm lucky because I'm in Canada. I'm part of the Canadian part of our global solutions team, but I am part of this global solutions team. So it's interesting because we get to see the trends in other markets like the US or UK, Europe, Australia, et cetera, even Asia. And I think that the definite trend that we're seeing, and it's coming from the bottom up and top down. It's coming from advisors wanting to move in this direction, but it's also coming from the firms that they work also wanting them to move in this direction. That is a little bit more of a delegation of the portfolio construction and investment management side of financial planning. Because going back to the kind of earlier reference of the pie, the portfolio construction, the security selection and all that is just one piece. There is insurance, there is estate planning, there is marriage counseling. I mean, advisors do a lot for their clients. The actual investment management being one piece of that pie. And to your point earlier about trust and relationship building, hey, there's a lot of very smart advisors that can build very, very good portfolios. There's no doubt about that. No one's suggesting that they can't. But when you look at where that hour is best spent during a day, is it best spent, behind a spreadsheet, tinkering with, should I buy, U.S. equity fund A or U.S. equity fund B? Should I be overweight Canada or underweight Canada? Those are all important decisions. But is that the best spend of the time, or is it making sure you're in front of clients, making sure that you're, business building, but also taking care of those clients that you have, et cetera, planning for the next generation, all that kind of stuff. And the trend that we're definitely seeing, I'd say it's further along in the U.S., is definitely more delegation. So whether it be, kind of your traditional fund-to-fund portfolio, whether it's a more, advanced multi-asset portfolio like we run, the model business is very big in the U.S. It's just starting in Canada. Various different ways of delivering portfolio solutions to advisors is definitely the trend that we're seeing, and actually quite a big growth area for us in other markets and starting to be in Canada. So, that's one of the trends that we definitely see at the advisor level. There's obviously some hesitancy to do that for some advisors because many people like doing it. If they're like me, I really enjoy reading about economics and markets and all that kind of stuff, and it's fun. So for me, it's fun, and many advisors enjoy that. The other challenges, many advisors believe that that's their sole value add to the client of generating them a certain rate of return. Like them as the portfolio manager for the client is why the client is paying the money. And of course, the goal for many advisors is to transition that way of thinking from, I'm the portfolio manager, I will get you in and out of good stocks, and that's why you pay me, to I'm going to make sure that your financial plan is sound, that we've done the proper planning on the insurance side, on the will and estate side, and all the other stuff that comes around that it's not, the client is not hiring a portfolio manager, they're hiring a financial planner and everything that comes with, of which just the investment management is just one piece of that pie.
Yeah,
so, that's a trend.
I'm just going to say that, firms like yours, you literally have hundreds of people doing this work every day full time. having been an advisor in the past and then having been advisor facing as well, what I discovered is that the more time I was in this business, the more I discovered how little I knew as an individual. And that's something to come to terms with at some point. Like, I think what you're saying, I think the trend towards an increase in delegation, personally, I think it makes sense because markets have become more complicated with the end of this very long-term mega cycle that we've been in for 40 years.
Yeah, and it's not going to get
No,
easier.
exactly.
And I want to be clear too, it's not black or white. It's not you build your own portfolios or you fully delegate. There's a lot of in between. And, we kind of see a few models out there. One is, of course, the full delegation. They might pick one or two or maybe three suppliers or partners and then really build portfolios for clients, really 100% using more managed solution type programs like Quotential or LifeSmart or the fund of ETFs that we've launched or whatever have you. There's also, the in-between, using a managed solution as a core part of your portfolio, let's call it 50 to 70%, but then just building a couple, using a couple of your favorite active mutual funds or your favorite ETFs around the edges to sort of give it, your own piece of flair is another delegation model. It's not all the way there. You still have some skin in the game, but you are delegating the bulk of your portfolio, and the core part of your portfolio is in something that is probably a little bit more predictable, a little bit more diversified, etc. The other way is more
for advisors. That adds a layer of satisfaction for the advisor implementing some of their own personal ideas into their relationship with their client, into their portfolios. But also, given the long run, it adds to the advisor's satisfaction in terms of the potential success of their own ideas. For 50 to 70%, why not put the hat down, take that hat off and make...
Yeah. And I want to be really, really clear about something. We're by no means suggesting that there are not advisors out there that are building great portfolios on their own. And in fact, I would hazard a guess that some of them are building portfolios that are outperforming ours. There's probably many that are building portfolios that are vastly underperforming ours as well. So it's not a we're better than you or you're better than us type of a thing. It's really more of an efficiency thing. It's really more of a business decision. It's where your time is best spent and where your expertise lie. Again, to your point earlier, we have a team of about 50 people that help us build these portfolios. So it's not just myself in an office in Toronto putting these things together. We have a manager research team that help us select the different funds and ETFs. That's a team of 10 people. We have an asset allocation committee, which I'm a part of the senior leaders within our group that help make those sort of dynamic asset allocation decisions. We have risk management professionals that run the risk management data, the risk data that pop into our inbox every morning to see the different bets, the different risks in the portfolio. We have portfolio construction analysts, et cetera, et cetera. So there's a lot of people behind the scenes that go into building these portfolios. Again, I'm not suggesting that there's not advisors out there that don't build great, well-diversified portfolios that meet the outcome needs of their clients. It's more for the potential extra few basis points that you may be able to earn or maybe underperform, or who knows what the outcome ends up being versus ours. But is that where the time is best spent? And definitely the trend in the US is from the bottom up, many advisors feel that that's not where their time is best spent. But I'd say also even more harshly, the firms that they work for are pretty much mandating that they don't spend time there because they've acknowledged that, or they've understood that that's not the best time for advisors to spend. So anyway, long story short, I think that's the trend. We definitely see it in Canada. I think we typically see after periods like this where we've had a lot of market volatility, where arguably a lot of people were caught probably offside with too much credit, maybe with too much commodity exposure or whatever. We tend to see a bit of an upsurge in people moving more to less do-it-yourself and more of a partnership with someone like ours. So, but bottom line, I think it's a trend that we're seeing in other markets, and I think it's a trend that we continue to see here in Canada as well.
So let me ask you a macro question now. When do you think we get out of COVID-19?
Sure, and I could give you the assumptions in our base case, but do bear in mind, and we are not medical experts, and we do get a little bit concerned when there's a lot of people coming out with views on how this virus breaks one way or another that I've never been to medical school or haven't taken a science class since grade 10 in high school. So we have to acknowledge our own limitations in that. Now, that being said, we read a lot. We get a lot of experts on the phone, and we definitely are trying to form some opinions. I think that for us, from starting with the economy, again, it's probably more of a U than a V, in the sense that it looks like at this point, the worst is behind us as far as the acceleration of new cases and deaths and hospitals being overwhelmed. It seems like that is on the downturn. The risk, of course, is that if we kind of declare victory and everyone goes back to work tomorrow, the likelihood of a second round is very high, in which case it's one step forward just to take 2 to 3 steps back, and in fact would force these social distancing measures to last even longer. So, our view is it's a bit of a slow return to a new normal, in which case, as testing becomes more prevalent, as, maybe treatment methods become more prevalent, we're allowed to release more and more people back into work. Now, that being said, I think it's going to be slow. If the government tells me tomorrow that I can go back to work, my firm is probably going to be a little bit more conservative and keep us home for an extra couple of weeks. Because to be honest, there's not been really any disruption from our business as far as working from home or going into the office. So why take the risk? But that means I'm not taking public transport. I'm not eating out and not going for drinks after with my friends and consuming. So, I think it's a little bit of a slow economic recovery. But in our view, there's a little bit of light at the end of the tunnel. But there's some risks to either side. Things could go a lot better. I mean, there are many PhD doctors, people at various universities, health people, whatever, all over the world working full time on this. There's hundreds of different tests going on vaccines and treatments. If some of those start to prove effective and testing becomes more prevalent, we might be able to get out a lot quicker than we think, in which case there's a bit of a stronger recovery and the economy gets back to sort of a better state quicker. The opposite is also true, of course, if we go out too early and maybe this virus is worse than we thought or more contagious or whatever, there's more long-term health implications than we think. That's going to force these lockdown measures to stay a lot longer. And I think that's obviously going to cause the economy to go a little bit slower. So, the truth is probably somewhere in between. We would expect, a bit of a slower release, as the weather gets warmer, as some of these measures prove effective and the curve flattens, we'll get back to work slowly and in steps.
In terms of and we'll get back to, in terms of the markets, particularly the equity market, how do you see, like right now, it appears there's a great deal of optimism. There's and I guess the question is, has the market gotten ahead of itself? The other side of it, of course, is the bond market. The bond market seems to be telegraphing a high degree of pessimism. And is that model correct? Is it correct to say that the bond market is telegraphing high pessimism right now? It looks like a bifurcation, right? It looks like the stock market is saying everything's great and the bond market is saying the opposite. But is that in fact the case? Or is there some alignment somewhere in between?
Let's start. Starting with the stock market, I think there we would argue that it is a little bit ahead of its skis. The rebound that we saw was quite dramatic, obviously. And like I said, there's a little bit of light at the end of the tunnel, but there's still a lot of uncertainty on which way this goes. And even if things go fairly well, it's probably a fairly slow recovery. So, we're, like I said earlier, we took some opportunities to add a little bit of risk to portfolios, but we by no means were very aggressive in that, because we do feel that we're going to see some other opportunities to add a little bit more risk. So we would not be surprised to see markets pull back again, more of a zigzag, around here for a little bit, giving us, a bit of an opportunity to add. But that being said too, the government reaction's been pretty incredible, and don't fight the Fed and all that would suggest that they're really putting a bit of a floor on the market. So, for us, if you look at the equity market, it's probably, I would err it's on the a little bit overly optimistic side. If you go into the bond market, I think you have to depends on what part of the bond market you're looking at. If you're looking at credit, it's still suggesting that there's some concerns. If you look at where investment grade and high yield spreads are, they're definitely quite high versus where they were, before this crisis. Now, they're well off the highs of kind of the peak pain part of the market. So those spreads have come down quite a bit from those extreme levels, but they're still fairly elevated. So they're telling us that things are better, but not. There's still
So even with the Fed stepping in and widening their support in the credit market and basically deciding to buy pretty much every corner of the bond market in order to support it, there has been narrowing of spreads from the widest, but not, as you just pointed out, there is still a degree of pessimism in terms of what the final outcome is in the next year or two, what happens to some of these companies. Yeah, no, absolutely. The Fed hasn't actually bought any high yield bonds yet, right? It's sort of more like just the announcement or the signaling effect has kind of caused those spreads to go down. And, for us, again, when we nibble, as we've been nibbling, it's been more on the investment grade side, because I think to what you're getting at on high yield, there's still some, if you look at what's happening with energy, energy is a bigger part of the high yield market. And some of those companies are going to be in real trouble. Now, we'll see what kind of bailouts happen and whatnot. But at energy prices where they are, there's definitely some going concern risk. So, we do expect defaults to pick up. We do expect, a little bit more pain at the kind of
at the bankruptcy level in some of those places. So we're a little bit hesitant to get too aggressive in high yield because, even though yields are higher than they've been historically, they're well off the highs and they're well off the levels we saw in like 2008, 2009, for example. So there could be some room for spread widening still there, and hence probably pays to be a little bit patient on some parts of those markets, but opportunistic. To your point on the government bond market, then, when you look at where yields are today, it would suggest that we're getting ready for a continued and long-term recession. But that market is being fairly, I don't want to use the word managed, but influenced by the Fed and other central banks. Interest rates are at zero pretty much across the board. So that's kind of pinning the front end of the yield curve at a fairly low level. Obviously, there's a ton of issuance that's going to happen from the Treasury and other places to pay for all the programs that they've announced to support the economy. But the Fed and other central banks have said that they're going to buy up a lot of that debt with quantitative easing programs. So that's really kept a pin on how high yields have been able to get, and in fact has really pushed yields down to fairly low levels. So there is some, I guess, unclear signals from that part of the market, just because there are some other kind of non-market influences. The price discovery is maybe not as efficient in that part of the market as it normally is because of the influence from governments and things like that. So, things like the shape of the yield curve and things like that are good signals and things we need to look at, but we have to take them with a little bit of a grain of salt as well, just given the action that central banks are kind of partaking at this point.
What do you see as possibly the biggest opportunity in markets right now? If you had to pick one.
The thing is, I would be a bit patient, but I think at some point it's the opportunity to add a little bit of risk through equities and some of the riskier credit markets. I think it's a little bit early to be too aggressive there for some of the reasons I talked about, but I think that's one area because, if you look at the other side of this, and again, we talked about kind of the uncertainty on how the recovery might look and what the economic trajectory ends up being. But let's just, for argument's sake, say at some point we get through this. However that looks, at some point we get through this and people get back to work and whatnot. We're going to be entering an environment with very, very low interest rates, with probably fairly hefty fiscal measures in place to sort of support spending, and probably a little bit of pent-up demand as people have been going a little bit stir-crazy in their homes and are looking to get out and do things. Now, I don't know if people are going to rush out to go on cruises, but there are some things that people will go out and probably do. So in a way, the other end of this looks like a pretty favorable environment for risky assets, assuming we don't get, kind of runaway inflation out of all this, which, is not our base case. So, I think for many investors, it's, looking for opportunities for those that can handle it, of course. And this is, of course, the conversation financial planners
easier said than done.
Those that can handle those that can handle a little bit more risk is look at that allocation. And if you were, an 80% fixed income, 20% equity person, does it make sense for you to move up to a 60% equity, 40% fixed income type portfolio? Because the likely expected returns over the next, 5 years or plus, our view is that there's a pretty good likelihood that we see equities do a little bit better than certain parts of the bond market, developed market government bonds and cash and things like that. So I think that's the opportunity.
What are you guys seeing as some of the key top-down areas that you would want to take small bites out of as things evolve here?
Yeah. I mean, the other one too is, and this is going to be a longer term. I wouldn't go here today, but when you look at energy and energy prices, clearly we've seen a monumental decline in energy prices. And, the cure for low energy prices is low energy prices, because what we're doing now is we're getting a lot, and we're going to get a lot of production cuts. So supply is way too high. Inventories are way too high. It's definitely going to take some time for that to get worked out. And demand is very, very low. And at some point, demand will slowly creep back and that supply demand imbalance will improve. But, we're not yet all driving electric cars and it's all solar energy. I mean, there's still going to be a need for that. So I think at some point when you look at the valuations on some of these companies, there's going to be some opportunities. The question, of course, now is which ones will survive and which ones will go away. So for us, it's a little bit early and a little bit risky to kind of get too aggressive on energy or equity markets that are more, focused on energy, like Canada, for example. But at some point, that's going to be a pretty interesting opportunity. So that's something we're looking at, but I think it's still a little bit of ways away, because when you look at the amount of inventory that's out there, floating on giant ships off the coast of California, for example, it's going to take a little while to work that through. But that'd be an area to keep an eye on.
In terms of the earnings outlook for this year, I imagine you guys have already written down 2020.
Yeah. And, that's another area where you have to be careful about some of the published data. A lot of people will look at earnings analyst estimates and things like that, and they've been very slow to reduce earnings estimates. And that has a few effects. It obviously makes multiples look a lot more expensive. it sort of fools with kind of valuation metrics and things like that. So yeah, earnings, it's very much throwing a dart at a dartboard at this point, because companies are not guiding anymore. So there's no real guidance coming out of companies. Analysts are not really being that quick to upgrade their analyst expectations because they don't know. So they're in no rush to put a number out there because there's some career risk to that. So it's really driving a little bit blind here on earnings. We just know they're going to be bad. Like, they're going to be terrible. And then we'll sort of see how they go. But there's some clear distinctions. You look at an Amazon, you look at a Zoom Media, you look at Netflix, Peloton, these are companies that are probably benefiting from this environment. You look at Carnival Cruise Lines or any airline, I doubt their revenue is up very much. So there's definitely winners and losers from an earnings perspective. And you didn't ask, but I'll answer the question you didn't ask is, and I think that's going to be key going forward to having some active management in portfolios. There's definitely been a movement towards passive investing, and we definitely are buyers of using ETFs and passive tools to build well-constructed portfolios, no doubt about it. But we also want to make sure that we're allocating some money to some active managers that we think can differentiate a little bit from a benchmark, because there's definitely going to be some sectors of the economy and some parts of the market that will do quite well in the new normal of kind of social distancing and virtual everything, and others that maybe will be a little bit left behind. So I think that's important as well, to have a good handle on the types of managers you're kind of in bed with, and that they're doing the job of kind of being active in the right places, I guess.
But we've had an 11-year run on growth as a factor and investing in indexes where both of those have outperformed. The value factor appears to be deeply undervalued. Would you say that investors should consider, for the long term, rebalancing in the direction of the value factor?
Yes, maybe with a caveat. So I think one thing is when you look at what's done well. Some of the parts of the growth market, especially in the US, it's going to be some of the technology and some of those companies. The trend there is sort of the winner takes all capitalism. And there's a lot of great books out there that are kind of talking about this. They're very interesting. And it's really the sort of network effect and all that kind of stuff. So the Amazons, the Facebooks and all that, those kinds of things have kind of a built-in advantage because they own the network in a way. They're continuing to do quite well, and probably in the new normal will continue to do quite well because they don't have kind of retail stores and things like that. So in a way, that some parts of those markets could continue to do well. That being said, when you look at value, there's some sectors that do look interesting, like energy, like I said, at some point will be a pretty interesting place to potentially be as a value investor. But also when you look at some of the value sectors, you have to worry about kind of the whole value trap mentality, because, if you look at some of the value sectors like airlines or some of the industrials that might need bailouts and things like that, it's hard to say, what that looks like going forward if you're getting a bailout from the government, and then that government is also taking an equity stake that's going to limit dividend growth and buybacks and things like that. Are those companies really going to rebound that quickly? So I think it makes sense to still have a bit of a balance in a portfolio. If you've done extremely well by being way overweight growth and momentum in portfolios, trying to move a little bit more to the middle makes a little bit of sense. But I would be a little bit careful about just buying value kind of passively. I talked a little bit earlier about our risk management team and how we look at risk. One interesting way to look at, to kind of x-ray your portfolio is to look at it from a factor perspective. Right. I think that's more where you're going. And when you look at the factor exposures of a lot of people's portfolios, especially US equities, it's probably a lot of growth, a lot of momentum, maybe a lot of quality. Those are the things that have done really, really well. And we know that people tend to kind of, move towards things that have done well. So I think maybe what you're getting at, which I completely agree with, is you probably want to have a sense of kind of where you're overweight and maybe where you're less exposed on a factor perspective. And I think to your point, many people are probably fairly underexposed to value. So that's one thing that we do, within our equity holdings, is look at those factor exposures. And there's different ways to kind of balance that out. Of course, there's passive investing and of course, active funds, like you mentioned. There's also a lot of factor ETFs out there that can give you kind of specific factor exposure. And those are great tools as well to potentially offset or to complement, holdings that are maybe a little bit more growthy. So yeah, there's a lot of ways to do that. But I think that, our conclusion is we're probably not to the point where we want to kind of overweight the value factor in our portfolios or completely sell out of the growth factor in the portfolors, but maybe a little bit off the table.
Rebalancing from the growthy areas to some of the value areas. Within the equity sleeve, like adding the value factor to the equity sleeve as not replacing with value, but might provide some of that offsetting correlation as well.
Yep. Yeah, I think that makes sense. As a multi-asset team, we're a little bit agnostic to the whole active passive debate. Now, from a firm level, and this is probably more historical, many active management firms, of course, this is many years ago, we're obviously quite for active investing and cautionary maybe on more passive investing. And of course, since then, these same firms, including ours, have launched a bunch of passive ETFs. So, for us, they're just different tools. I mean, we're trying to build well-diversified portfolios, whether we get some exposure from a passive ETF and complement it with a smart beta factor ETF and a couple of active managers and maybe more of a core holding. I mean, for us, it's the sum of the parts that's more important, and they're just tools for us to build. So, we're a little bit more neutral on, is active or passive better? Because in our mind, they're both good, and they're both kind of necessary for different reasons in a portfolio that we're constructing. So it's maybe a little bit of a different tack than if you were to go out and ask a U.S. value active manager on their thoughts on active versus passive. They may be a bit more skewed in their thinking towards active good, passive bad. But from where we stand, they're just tools to make it more efficient.
Yeah, I think portfolios. It goes to the evolution of the company, right? I mean, Franklin Templeton has evolved from the days of Sir John Templeton. You have the Franklin Resources part, and you have the Templeton investments part, and really it's evolved along with the market. And maybe that's an idea that advisors and investors need to know more about, which is what you just talked about, which is that as a firm, you've become more agnostic about any sort of ideology.
Yeah, it's interesting in a way. The firm has evolved, but in a way, and I think this is a little bit by design, the sub-investment teams within our firm have sort of stayed true to their philosophies and processes, right? So Templeton is a value manager. Now, do they do it the same way that they did 20 years ago? Of course not. There's changes in their process, but deep down, philosophically, they're still looking for undervalued stocks that they think are undervalued by the market that have the potential to re-rate. The Franklin Group in San Mateo is much more of a growth-oriented manager looking for high-quality growth companies. You've got Bissett in Calgary, which is more of a GARP manager. So I'd say the sub-investment teams have evolved in the sense that they do things differently now than they did before, but their philosophies have been pretty stable. And what the firm has done a really good job at is, rather than trying to force change on some of these underlying managers that may simply be out of favor, but nothing is necessarily broken, is more through acquisition, is build the stable of investment teams and investment options that we have within the firm to help people like myself and our team to build portfolios. So, we've done a lot of acquisitions in the alternative space, in the local asset management space. So UK, Australia, we've bought local asset managers, having the smart beta ETFs, having the passive ETFs, and a lot of the alternative stuff that we're doing. That's really more the evolution of the firm, in the sense that the toolkit is growing. The toolkit is a lot bigger than it was 10 years ago, 5 years ago, etc. A lot of the building blocks have not necessarily changed. We don't want Templeton to change their investment style. We want to have access to a true value manager, because yes, they've been out of favor, but at some point they're not going to be out of favor. We don't want them to suddenly just jump on the growth horse and kind of ride that because it's doing well. Same for some of the other managers. So I think that's the interesting evolution of the firm, rather than say the individual investment managers necessarily changing their spots too much. And again, for people like ourselves that are building multi-asset portfolios, or advisors that are building their own multi-asset portfolios, that gives them a pretty interesting breadth of tools to build, really efficient, well-diversified portfolios with. So I think that's sort of
stepping into the role of an advisor. When I call on you, what I would want is objectivity. When I have a question, is it time to invest in value? Is it time to continue on? Is it time to rebalance in this particular direction? I'd like to feel as an advisor that when I call on you or call on anybody within the company, that when I get the answer to that question, it's an objective answer, not a subjective answer. I think that has real value. And I think that's really the value of how Franklin Templeton as a company has evolved, is that you're able to say, yes, no, I don't think so, or, we don't think so, or let me refer you to somebody who can give you a more specific view of what you're asking. There's resources in there because of the evolution of the company.
Yeah, and I think that, the solutions, the multi-asset solutions team is kind of uniquely positioned for that, right? Like if you were to go to a UK equity manager and ask them what their views are on the UK, it's sort of unlikely that they're going to tell you it's just the wrong time to be in the UK equities. You should be selling your UK equities, because they're obviously a little bit biased. Whereas we can very easily say, hey, yeah, you know what, UK, we wouldn't touch it right now because of this, that, and the other thing, and then tell you maybe 3 months later that, hey, it's sold off, valuations are more attractive. This is probably more of an interesting time to buy UK, because again, in a way, we don't care. We have the flexibility to be in or out of various asset classes or markets, so we in a sense can come a little bit more objectively to those types of things. And again, it comes through too in our portfolios. We clearly hold certain of our funds, and we clearly don't hold others of our funds. And it's not to say one fund is good or bad. It's just we know what we need that might work for us and would fit in our portfolio, and that's going to be reflected in what we hold. We're not forced to hold anything that we don't want to, and hence I think it does give us a little bit more credibility when we speak to advisors about our views. Doesn't mean we're going to be right, but at least I think people know that it's not coming from a place of trying to sell you something.
You guys are really at the nexus. You're really able to provide that objective perspective when advisors need it the most.
Yeah, no, I agree.
Mike, thank you so much for your time. It's been a really valuable, enlightening conversation. I hope we can do this on a more regular basis. It's been great talking to you. Thank you.
Well, thanks, Pierre, and thanks to all your listeners. I hope everyone stays safe and best of luck in the markets. Thank you.